All right, thank you for the introduction. And today we'll be talking about stablecoins and CBDCs. I'm joined by Sinan Koç, the founder and CEO of BuyLira, the first stable cryptocurrency to be pegged to the Turkish lira. Wanji Zhang, the founder of Conflux, a next generation blockchain protocol, and also a Chinese CBDC expert. Carmela Cadet, the CEO and founder of MTech, a fintech services company helping emerging markets leapfrog financial services using blockchain technology. And also Gregory Klumov, the CEO and founder of Stasis, the creators of the world's first Euro-pegged digital asset. So I'd like to open this first question with, what are the biggest misconceptions in regards to the stablecoin, CBDC, and Bitcoin conversation? And I'd like to direct this one first to Gregory, if you have some thoughts on that.
Sure. Thanks for having me here. Welcome, everybody. First of all, I want to mention that the stablecoin concept is something where you issue a digital asset and you have backing in form of other assets held in custody accounts. Say it could be a fiat currency or could be some commodity. It's not necessarily means that the asset is pegged, because on the secondary market, the asset will trade depending on liquidity and depending on the accessibility of those reserves for customers. The CBDC concept is something where a central bank can issue a direct account for a consumer and credit some assets, some cash, digital cash there for consumers to spend. First of all, it's a centralized technology by its meaning, right? It's a centralized operation. It doesn't need blockchain at all. While the stablecoins that currently exists, they use the centralized infrastructure like Ethereum network to custody, settle, and clear payments. Historically, these services, custodianship, clearing, and settlement, were oligopolized, because you could only process a transaction involving of some fiat currency through a network of banks or a network of custody providers. So it's very interesting to see how this thing develops, and will be a regulatory regime available for something like stablecoins to allow them operate and compete for the customer using some value added services they offer. Bitcoin, to some extent, is the most decentralized example, as it uses the same technology, blockchain network, but its value is fluctuating every single minute. So you cannot really think in Bitcoin terms when you pay for a coffee or for your iPhone or some product or service. You always think in the currency you make money, in the currency you pay taxes with, and that's why there'll be a big debate whether one can replace another or substitute. I personally think Bitcoin will be the gold, the next gold for the humanity, where people just save money, and stable coins will be commercial entities that provide payment solutions to multiple industries, where there is a need for programmable money, where there is a need for remittance space, where you just custody the funds yourself and then send them on demand when you need it, the minute you need it. And it could become a big part of the so-called on-demand economy. If you think of video streaming that became an on-demand economy relative to the traditional TV shows, if you think of transportation, which became the on-demand service relative to the buses or trains that run by schedule, if you think of a lodging industry that became again on demand, you just book yourself an apartment in some place when you need it in some country and then travel to it, relative to say hotels or long-term rents. Medical services, all that becoming a part of a big on-demand economy. And last piece of that puzzle is on-demand settlement, which stablecoins can facilitate.
Absolutely, I would totally agree. A lot of these things appear to hinge on a new vision of how the economy works. And I'd be curious if any of the other panelists had some additional points on this new economy and how these digital alternatives might fit into that scheme.
Hi, Liam. I'll jump in here. To answer, I guess to add one more to the list, I think one of the biggest misconception is really around Bitcoin. And I think Greg alluded to that. The fluctuation of Bitcoin is not something that is easily managed for day-to-day use. And so I've been on a mission to change the thinking and change the idea that we can solve financial inclusion with Bitcoin. I do believe that it is a wealth building asset, just like stocks and equities and gold. I think it's a good example of that. But how do we kind of change and kind of will the excitement back just a little bit from where we thought that Bitcoin was maybe 3 years ago, right? Saying that this is going to replace everything. So for me, financial inclusion is something that I pay a lot of attention to, especially in the emerging markets where the news got ahead of the reality that this is going to solve financial inclusion. So that's that for me.
Yep.
But Greg did a good job. I think it will coexist.
Yep. Thanks. I'd like to add to the previous two panelists that we can see Bitcoin is actually on the way to become a gold. Like gold, in the very old times, people like hold it personally, and then institutions start to hold it, and eventually kind of a lot of central banks make it like formal reserve. Well, right now you actually see Bitcoins start to own by individuals and miners, and now institutions like endowments or mutual funds like Grayscale start to step into the field. And eventually, I believe central bank may kind of consider it as an alternative to gold as well. But it takes a long process, but I already see institutions start to step in, along with like custodian service or other kind of infrastructure become more mature. And also like for stable coins, public chains, I start to replace the functionality of Bitcoins as a kind of a cross-border intermediary. So Bitcoin start to lose that part of functionality, but play more role of value reserve instead of like transact intermediaries. And stablecoins actually start to play that role. That's why you see the insurance of USDT start to grow very quickly, but that doesn't really pump out the Bitcoin's price, right? Those two were like quite correlated in the past, but now they start to decouple. So that's my observations, which kind of strongly support the conclusions that been mentioned by the previous two panelists. Yeah, that's my thought.
Yeah. And how I see it is that the current banking system is a messaging system, and like Swift is a messaging system to transact these values. And for with Bitcoin and then Ethereum and then different layer one projects, for the first time there has been a decentralized messaging system. And Bitcoin is the first one to start replacing gold as a store of value. And stable coins are a potential to start replacing a traditional money in your bank accounts as a new messaging system.
And if maybe we can start to include some national digital currencies into the conversation, what are some of the major advantages that these could have for any economy? And maybe you want to take that one on, Sinan, as your last one to speak.
Yeah, so how we see digital currencies are, we believe that in the next 2 years, all of the government currencies are going to have a stablecoin version because it's a better messaging system. And right now there are some limitations on the speed of the blockchain and the ease of use. And we believe that these are going to be solved in the near future with different layer one projects as well. And the only thing we know that it would be taking out the control of the centralized organizations and go through cost cutting to give the retail a cheaper option.
And did you have some thoughts on that as well, Carmela?
Sure. So one of the biggest examples that we're seeing right now for CBDC is around kind of filling in the gap that the banking system does not fill. We published a working paper last week that talked about digital cash, for example. When you think about central banks and their role primarily around the sovereign currency management, even so, once we get into the banking system, it gets pretty complicated in the sense of what banks will be able to do and what jurisdiction and how that marriage will come together. If you look at Risk Bank, kind of expecting the conflict with the banking sector, versus when you look at Bahamas that issued a kind of a sovereign currency naturally in the retail space, and then asked the payment providers and the banks to build on top of it. But we think that different countries will have different strategies and different reasons they do it, right? But that core across all of it. In the US, there's about $1.8 trillion of cash, of US dollars circling the world, right? Every country can get better control of their physical cash, not for traceability. And I think a lot of talks about that, as far as fear of privacy and security around that, the design, and all of us in blockchain kind of can think about how we implement cryptography and encryption to say, how do we preserve privacy in that? But that would be solving a real problem for every country to digitize their cash.
Yeah, also I'd like to provide a perspective from China for the DCEP, which have a very like high exposure in the international medium. So far, DCEP hasn't been rolled out yet, but it has already started to test it in some cities like Shenzhen, Suzhou, Chengdu, and Agricultural Bank of China start to test DCEP internally. And the goal that the central bank claim is to use DCEP to replace M0 instead of actually, make it the money, right? So they still would like to use a two-layer structure to distribute the DCEP to retail users and enterprises. Because if they disintermediate the banks, the commercial banks, they will lose a lot of the credit information that the commercial banks will own, and they know how to allocate those capital efficiently. But with the usage of DCEP, that definitely help the central bank to kind of move their the monetary policy more quickly, swiftly, and more responsibly to the market. So that's something I think that's why they felt like it's time to kind of roll out the DCEP, and also they would like to see if this can help break the doors of internationalization of RMB. Because in some usage scenarios, people even don't have to hook up to the internet. People can kind of transact DCEP with each other, even both are offline. So that probably can help some usage offshore in some scenarios. So we will see, but it hasn't been fully released yet.
Gregory or Sinan, did you have anything to add to that? Any other considerations about a local national currency?
So if I may add that central bank will never issue something that will face directly consumer. Otherwise, it is risking collapse in the whole commercial banking sector. To some extent, the money is already digital and the cash is totally retail product. But cash is also used to make deposits to the commercial banks, which are insured by national regulated insurance corporations that insure commercial bank deposits. So imagine you've got suddenly an option to deposit money with a central bank instead of commercial bank. In an area of zero interest rates, there is not much of a juice, right, to deposit with a commercial bank anyway. And suddenly you've got a risk-free option to store your cash, say money, relative to the riskier option, which in the worst case, you get nothing, you get no yield, but the worst case you just get the insured amount from your bank account. So what will happen, there will be a bank rush run on all the commercial bank deposits to move them into the central bank. Since the money is already digital, 90% of all money is already digital in form of the centralized ledger on a commercial bank numbers. I see the only way is to allow commercial companies to be licensed for, say, e-money 2.0 regime, where they can issue that electronic money holding reserves in governmental securities or central bank themselves, depending on their asset allocation strategy, and then stay 100% backed as an institution, because all the banks have a significant leverage to their balance sheet. None of the bank is 100% backed. In fact, most of the banks have leverage up to 20, 30, or during the financial crisis, we learned even up to 100 relative to the capital they have. So that means even a small run on the bank instantly triggers a liquidity crisis and a bankruptcy.
Yeah, I'll jump in, Liam, to say that, well, the Bahamas issued a natural CBDC to people directly before the banks were, even onboarding, before the PSPs were onboarding. That initial phase was directly to people. I think we do see a scenario where central banks establish a new channel, because when you think about cash today, you're right that it does go through the banking system, and the central banks care about not disintermediating the banking system. But, for all intended purposes, we can agree that between capital management, loans, and so on, that the banking system is still absolutely needed. How the commercialization and the profitability of banks, get created within a world of digital currency, I think we can all agree that the models will have to be different, and they all will have to think about how they add value now. But there are ways to do it, right? And the reason I'm focusing on that is because we have a big gap around the world that the banking system is not, it has not filled. And I am having conversations with central banks and saying, you are the owner of the infrastructure. You have a responsibility and an opportunity to fill that gap, right? Some countries have a lot of people who are still unbanked, and they don't have a rich banking system as other countries. So there is a gap for central banks to fill. So now I agree with you from an e-money issuance perspective, fintechs coming into the bank, we do see a partnership with fintechs and central banks to say, how do we provide you better technology? And from a legal perspective, you are the settlement bank, you are the issuer, but we are the technology provider that enables you to manage at scale individual accounts for people. So that's our position. At least MTech, we want to be that fintech for central banks that introduces blockchain technology. Again, imagine a digital cash blockchain where any cash transactions get settled. You can imagine if you are concerned about banking disintermediation, that you can limit the amount of the wallets, for example. There are different approaches to do that will incentivize someone to still have a bank account. And it would be the same as if you were to hold cash today, right? Just because people hold cash today does not mean that to disintermediate the bank. So there's a use case that we're putting our finger on, and we're going to drive that. And we hope that the central banks would consider digitizing their cash and providing a direct channel to people. And not to mention that this is a concentration risk for financial markets as well, right? To fully rely on the banking sector. This is why Bitcoin is good, cryptocurrencies are good. The democratization and the diversification in financial markets is very important. And that's the idea.
To add a couple points to that, so I want to talk a bit about the technological aspect. And we believe a lot that this technology is going to bring democratization to the retail users and allow them to access similar terms with the institutions. But so we're big believers of public chain and building stable coins on there. But what we believe is that the central bank digital currencies have to be hybrid, or they would have to have some privacy standards on public chains as well. But as they're touching to the retailers, they have to be on the public chain, so everything's more transparent and democratic. But once they interact with the retail banks or different central bank currencies, they should have their own privacy. And I'm a believer that banks are not going to be gone away or lost, and these fintechs and banks are going to be still operational. But as you said, they're going to be on the distribution side and to be able to reach the unbanked customers and the smaller amount people. But there's also a risk that the central banks might directly go to them, and the retail banks might be disintermediated as well. So time's going to show that.
Yeah, and I think there's this an emerging theme that is happening in this conversation also beyond this panel is that of inclusion and banking the unbanked. And if we think of places that don't necessarily have this traditional legacy financial infrastructure, is there a preference for a CBDC, or is there a preference for a private stablecoin, or is there just we just need something to improve the status of how we're moving money within our market. Whoever would like to take that one can go ahead. Yeah.
Okay, I can take that. So again, the power of open networks and blockchain is that you can take your wallet or a smartphone, download an app, and instantly have a checking account. You don't need to apply somewhere, you don't need to onboard, you just have a checking account by default because it's your right as a human and you deserve that right. You need to be able to transact freely. Similar to cash, nobody controls what amount of cash you can take, right? Um, Beauty of the blockchain is that it offers monitoring tools where you can always originate where that money comes from. Also, it disallows counterfeiting of the notes because if you know, in Europe, 500 euro notes are now being removed from circulation because they were counterfeited a lot. $100 US dollar notes is the single most counterfeited paper currency in the world. And it's a huge problem. Every year there are billions and billions of dollar equivalents found as a counterfeit and removed from the economy. So the cost of doing that, just the counterfeit problem alone, is so significant that the blockchain cash would massively solve that problem. And since the onboarding is so easy, you just download the app and then you have the checking account. It's a significant advantage. So I think governments should allow commercial entities to experiment with this technology, either in some sandbox environment or introduce some licensing regime, but it shouldn't be tough. It shouldn't be as hard to get, say, a banking license these days, because entrepreneurs cannot afford that. But since the technology significantly benefits society and is very easy to integrate and start working with, there should be some temporary or sandbox environments, like I said, where entrepreneurs can experiment with it.
I'd like to add one point that the blockchain-based money will actually help, will accelerate the competition of different national currencies. Imagine if there's a stable coins for all different type of currencies. I believe the people devout in those emerging countries who have a super inflation will prefer to hold, US dollar or maybe RMB based stable coins and spend their own money, right? And gradually that monetary system of that country will be washed by like a stronger currency. So we will see that would be a very interesting phenomenon I'd like to observe. Thanks.
Me too.
Yeah, sorry, I want to just add one more thing. And also in this situation, it's an interesting question where the central banks have the right to print money so they can affect the purchasing power parity of the retailer. And Facebook with Libra came out with a new project initially to have a basket of currencies where people can use it as their own currency rather than just depending on their country. And it's going to be an interesting avenue to see whether which one the retailers are going to accept and what the government pushback is going to be on it.
And I think just to kind of riff off the idea of the various devaluations of a national currency that we're seeing around the world these days, how would, I guess, an internet-based money, a blockchain-based money, a global stablecoin, whatever you'd like to call it, how would that mitigate against this kind of devaluation? Do we see one currency winning over another? Or I think 1G mentioned a little bit about this, but how does a CBDC mitigate against a currency crash?
I'd say it doesn't. I'd say it doesn't. There are things that, I'm really big on being honest about certain things. There are certain problems that we can fix, and then there are things that we're not claiming to fix. I think currency crash, it's a macroeconomic problem. You still have to figure out your trade flows. You still have to figure out how you diversify your economy. You still have to have a strategy on how you build trade. So that's what makes a currency strong. The fundamentals of that, I don't think change in digital currency just by changing the technology. What I do think, when we talk about ubiquity, and when we think about reach, blockchain does that, being able to have better traceability, better, again, not spying, but traceability of whether it's bad actors, and how do we design that? That's something that we're spending a lot of time on, given the anonymity or pseudo-anonymity nature of blockchain. But then how do you open it up in a very transparent way, to government to meet certain requirements, to meet AML regulation? But I think it's going to. I think it's if central banks and if governments are smart about it, the best that they will get from a macroeconomic perspective is at least a competitive approach, a competitive technology-wise, because that can be a hindrance, right? From a government competing, and your economy might be strong, but if your currency is easier to get into other markets and easier to use and more convenient to settle in, then you'll probably find people who use that even if your economy is stronger.
Yeah, in fact, CBDC doesn't solve that, but stablecoins do. They provide a more open market to the currency. And the situation where in Venezuela or Zimbabwe or Ukraine or Lebanon, last couple of weeks, there is a huge currency crisis when local currency dropped 5 times versus the dollar on the black market, because there is no other market, and the government doesn't want you to trade the currency on the other market. So the stablecoin, you will have the opportunity to transact at least. Yes, the price would decline significantly, probably to an extent that there'll be even a discount, but at least that will be an open market opportunity for the people who are holding that asset. With the central bank digital currency, it will be basically the same as holding cash within the country, but not having an opportunity to exit that particular asset.
And also to add something on that, so I agree that creating the representation on blockchain does not solve the monetary policies of the countries, but for the first time with this technology, there's a competition for the local currency that the central bank issues. And if projects like Libra gets penetration and people start using it as an actual medium of exchange rather than their local currency, then because the government has competition on that, they would have to step up their monetary policy game to create fundamental value for their currency, for the public to use it.
If there's no other thoughts, I think we can move on to this. I guess the elephant in the room is, recently Tether has gained a huge amount of steam. It's now the third largest market cap on CoinMarketCap today. And recently, the CTO of Tether, Paulo Arduino, he tweeted, "Tether will dominate the payments industry. Change my mind." And it's a leading question, and it's a bit controversial, I think, for some people. But I'd be curious to open that up to the panelists. Do you agree? Do you disagree? And why? Maybe we can turn that to Wanji or whoever's ready to take that on.
Sure, I'd like to take it first. So I believe Paulo is actually telling part of the truth, that USDT is actually stepping out of the circle of speculating in usage scenario of speculating crypto coins. Originally, like the rise of USDT is because of the September 4th of 2017's forbiddance of trading cryptos in China. However, the Chinese government still allows the centralized exchange to exist in China, but they forbidden the trading pairs of crypto coins against RMB directly. So USDT started to play the role of intermediary with crypto against USDT and also a USDT market against RMB. So they combine the two, so you still have that crypto against RMB, right? But that actually provide a huge demand market for USDT, and China becomes the best market with depth and liquidity of USDT. And the interest of USDT in the early days, 80% of those things flow into the big three crypto exchanges, China, Huobi, OKEX, and Binance. But now things start to change. USDT start to show up in places of cross-border trades between China and Russia, China and I mean Southeast Asia, and even not related to China at all. So we start to form a network that people use USDT as a cross-border, I mean, trade or capital transfer or remittance as a media of exchange. So that's why I believe Paulo has the confidence to say that USDT can become the dominant way in the payment like scenarios. But one thing they do have to solve is the compliance issues. When I say compliance, I'm not saying they either like the compliance with the United States. Probably more likely they will have to choose a side. They have to choose whether they will be compliant with China or United States, right? Because actually a lot of USDT users or holders Chinese, and actually their custodian of their US dollars are being held in a bank that could be controlled or could be tapped by Federal Reserve United States. And with the conflicts between these two giant countries, they can really create the problems. Let's see if like the dollars are like being seized by the US government, and a lot of Chinese people lose their like personal holdings, and that create a big social problems. So right now, $10 billion still not a big amount of money, but as that continue to grow, as I see this, the kind of the ordinary trade channels has been shutting down because of the virus, that will continue to grow, and that will become a big problems, and the government will start to show concern. Both United States and Chinese government start to show concern, especially Chinese government will show concern of that. And before they solve that problem, I don't feel like that will come to kind of the payment dominant like intermediaries, but we will see. This is actually a quite interesting way to see this unfold. Thanks.
May I add that?
Yeah, go ahead.
Okay, so I think Tether was a great example, and I was inspired by Tether to create an institutional-friendly stablecoin. But nobody really knows how much cash they have, right? So they claim they have 10 billion, but nobody knows how much. They have a significant first mover advantage, and they did a really great job bringing the community and growing the network effect out of this product. But if they don't regulate themselves to the point where they can become institutional friendly asset, no institution will hold them. To some extent, it's a music and chairs game where while music plays and some chairs in the room are standing, people are using Tether for some short period of time. But when the music stops, and I think it will stop someday, there will not be enough chairs for the people to jump on. So Tether reminds me of a mortgage market in US in 2008, where the really safe securities traded 100%, 100 cents on a dollar, and then suddenly 80 and then 0. So there is a significant risk that this dislocation happens with Tether going forward. And I could not recommend anybody holding it for a longer period of time. It's definitely not institutional capital. No corporation will touch it for a considerable amount of time until they come open-minded and tell everybody where they have the cash and make an audit of their firm.
Yeah, I'd agree. I'll jump in to say that I think there are a lot of things to figure out before they get there. Maybe they do have a strategy to get there, but I struggle, and this is for the stablecoin side of the house with CBDC. I think stablecoins will have to think very hard about what values and that they will bring into the ecosystem. And I think there's great value. I mean, if you think Libra will be successful, Libra is essentially a kind of a synthetic 2.0 is a synthetic CBDC, which is essentially a stable coin that would be backed by CBDCs and reserves. So if the plan is to address a particular market and you're designing a solution around that, I think Libra, for all intended purposes, said that they wanted to target the unbanked. That is a very specific use case where you clearly need an intermediary or at least a technology to come in to fill a gap. If you are going to be a USD token for the purpose of payment, I think you have some competition, some serious competition, especially if the digital dollar becomes a thing and is widely used. For intermediary, again, given that the USD is the #1 settlement currency in the world, I know some countries are trying to kind of rebalance that, but until that's achieved, what would be the value for someone to get USDT versus if you had the US dollar as a token, right? I think there are a lot of questions there.
Yeah, it's a great point. And Sinan, if you want to add a final note.
Yeah, of course. So to put Tether and USDT apart, I believe that stable coins are the future of the payment industry, because as an instance, once you pay something with your card, the POS processor charges between 2.5 to 3%. Stablecoins bring that down to 0.3% because there's decentralization, less people work, less costs. From Turkey to the US, once you send $1,000, the SWIFT cost is around $50. But if you do it on the blockchain, it's only 10 cents. So we believe no matter which stablecoin is the winner itself, but stablecoins are going to be changing the payment industry in the next 5 years.
I agree with that.
Yeah, it's an excellent point to wrap up on. I think it looks like we might have a few more minutes, and maybe we can get into it a little bit. But what would be, I guess, the biggest concern in terms of privacy when using a stablecoin compared to a CBDC?